Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. So many Australians are now investing in international stocks. Today, I wanted to get a bit of a guide to the issues impacting global markets and where the opportunities are for investors. Remember, this is general information only. You should speak to a professional before making any investment decisions. We often talk to Wilson Asset Management because they have a range of listed investment companies covering everything from micro caps to alternative assets. Catriona Burns is the lead portfolio manager at WAM Global and joins me this morning from New York. Catriona, welcome to Fear and Greed.
Thanks for having me.
And we know lots about investing in Australia. How would you describe the environment for investing in global shares at the moment?
Yeah, look, it's a very interesting period for global markets. I mean, so much going on, whether it's coming out of the pandemic, reopening, inflation woes, Ukraine crisis. So there's a lot happening in global markets, debate over what US Federal Reserve does, etc. So it's a very interesting time to be investing in global markets.
Okay, so within your portfolio, within WAM Global, what are some of the themes that you're thinking about? What's sort of the overriding macro view you have? Sort of the step before going down to stock picking is what I'm looking for.
Sure. So at the moment, the clear debate point is around inflation. You know, the US Federal Reserve has clearly come to the conclusion it's no longer transitory, and now markets are reacting to and have been, incredibly volatile on the basis of worries around how quickly central banks, and in particular the US Federal Reserve, will raise rates. And if you look at, prior cycles, very often is the case that central banks and the Fed has had a history of raising rates too aggressively and causing recession. So that's the worry from the big picture perspective. I mean, there's been enormous disruption in terms of supply chains. First there were trade wars, then there was the pandemic, and now we've had zero COVID policies in places in China. And so that's caused, an incredible amount of inflation. Plus we've had this enormous amount of stimulus, which has led to demand being also very strong. So that's the macro backdrop. In terms of how we're sort of thinking about the path going forward and how we sort of then translate that into the portfolio, really front and center at the moment is trying to invest in businesses that really have the ability to push inflation through and have it not, completely damage their margins. So those businesses with very strong industry positions that have the pricing power to deal with inflation. So they're the kind of the businesses that you want to own right now. I mean, thematically, we invest, in a number of areas that we think, on that longer term perspective will do very well. And, that's companies in areas like health and wellness, digitization of payments, data and analytics and automation. So they're just some of the themes that we think have longevity. But fundamentally at the moment, it's a difficult operating environment for businesses. And so really those businesses with pricing power are the ones doing well right now.
Okay, I want to get to some specific stocks in a moment, those with pricing power and some of those longer term thematics. Before we get there though, when you're investing and you're sitting in New York and you're looking at the US market and the US Fed has started its tightening cycle and is kind of well into that, same with the UK, same with New Zealand, same with Canada. Australia sort of at the beginning of that. Europe hasn't even started that. China, in fact, could be going the other way. In a sense, they're easing policy. How do you know kind of, you can pick a stock, but do you think much about the geographies and where they are in that tightening cycle? So a German company versus a US company versus a Chinese company, they're all in different parts of the cycle.
Completely. And, you're thinking about the sectors you want to invest in, you're thinking about the countries you want to invest in. And absolutely, as you say, they're all in different parts of their own economic cycles, but more broadly are affected by general interest rate, policies around the world, etc. So, yeah, particularly, I mean, even say, and Europe's a case in point. You saw this week the discussion around interest rate, how quickly the ECB will be raising rates. And that leads to volatility in markets because, the more aggressive, the more risk around the cycle. And particularly in Europe with the Ukraine crisis, I mean, the reliance of Europe on Russian gas, etc., is significant. And so the run up in energy prices puts Europe front and center for recession risk, in our view, even ahead of the US. So yes, certainly we have to consider both, the sectors that we think will do well in this environment, the countries and where they stand. And so, we're sort of always looking at that and then overlaying everything, because fundamentally, we pick companies that we think will do well in whatever operating environment. And so fundamentally, taking it down to the stock level and looking at valuation and where we think there's compelling upside.
Stay with me, Catriona. We'll be back in a minute. I'm speaking to Catriona Burns, lead portfolio manager at WAM Global. Okay, so let's take it to the stock level. What stocks are on your radar at the moment?
So to give you a bit of insight in terms of how we think about stocks before we then get to, decide whether we actually invest in them, we kind of think about, we have a process at Wilson Asset Management that's been used for over 20 years, and that really focuses on businesses that have strong industry positions, high quality management teams, solid earnings growth potential, and then a compelling valuation overlaid with a catalyst that we think will drive the share price higher. So that's kind of the process that we're applying when we're looking for stocks. That tends to often take us down to the small mid-cap end of the market, because those businesses are often earlier in their life cycle with significant growth potential ahead. And so when we're looking around the world, I talk to those thematics, that some of those themes that we think will do well going forward. And an example of that, say in health and wellness, we don't like to make bets on which clinical trial will be successful, etc. We love to invest, say, in that health and wellness space in what you equate to the picks and shovels of the industry. So those medical equipment companies that sell to every big pharma company, small pharma company. And so there's examples of that in the US, such as Avantor, which we think is a really great medical equipment company. We think they're very early days in terms of the potential for their business, so they're relatively small in Asia, where there's an enormous growth opportunity.
Yep.
They've got a phenomenal product portfolio, and they're adding to that through small bolt-on deals. They're kind of positioning themselves. So there's a bigger player, which we also own, Thermo Fisher Scientific, and Avantor is sort of running the Thermo Fisher Scientific playbook. And that business has just been a phenomenal grower over the last, 20, 30 years. And we think, Avantor's like a smaller version of that will do really well over time. And, I think the focus on health and well-being post-COVID, is here to stay. So that's, an area that we think will do really well. Automation's another one. Being based over in New York, every day I'm hit with the lack of labor, whether it's in supermarkets, restaurants, hotels. It's a huge issue at the moment. And we're seeing businesses across, every sector trying to work out how to take labor out of the cost base and automate. So we've got some great businesses in that area, such as Zebra Technologies, which is listed here in the US. And then, other businesses that we think will do really well at the moment, exchanges, they tend to benefit from volatility. And so we own Deutsche Börse, which owns the Frankfurt Stock Exchange. Yep. They also own Eurex, which is one of the world's largest derivatives exchanges. And stock exchanges and derivatives exchanges, they all benefit from volatility. And, we think we're in for a bit more volatility as we look forward. And so they're great businesses that have phenomenal market positions and pricing power. So we think they'll do really well as we look forward.
Given you're in New York, I can't not ask you about the tech stocks. Obviously, they're more household names to mum and dad and retail investors in Australia. Are there any among them? What's your outlook for the tech sector generally?
You could say it's been a bloodbath in particular parts of the tech sector, particularly the unprofitable tech stocks. So, what we've seen over the last, 10 years, et cetera, is this phenomenal run for these tech stocks. And some of them are wonderful businesses. We all use Google every day, Microsoft, et cetera. So they are great businesses, but, it's been one-way traffic. The valuations of a lot of these companies have really re-rated as interest rates have gone down. And really, as all this stimulus came into the market in particular over the last couple of years post-COVID, you just saw these incredible run-ups in these unprofitable tech stocks, which, if you don't have a clear path to profitability, we find that a very hard place to say, that we would confidently invest in. And I think it's really come home to roost in terms of, as we are seeing rates go up, that those duration stocks have really been hit. And in particular, the question comes with unprofitable tech. Can you fund yourself to profitability? And if you can't, it's a very dangerous setup right now, because who's going to fund you? You've had this era of free money, but that's changing as rates go up. So, we think particularly in that unprofitable end of the tech sector, that's an area we just don't want to touch. We think it is worth, picking through the rubble of a lot of these profitable tech stocks. And there are some great businesses. It's just the question of valuation. So it's really about doing the work, working out the growth profiles of these businesses, working out what will margins be longer term? Are they profitable? And so we are looking for opportunities there. But I think, you have to be very cognizant of having a view on what the earnings will do for these businesses going forward, and does the valuation stack up? Because a lot of valuations over the last couple of years have got very out of whack with reality. And so it is only natural that as rates go up that we have seen a reset in valuations.
Catriona, thank you for talking to Fear and Greed.
Thanks so much for having me.
That was Catriona Burns, Lead Portfolio Manager at WAM Global. This is a Fear and Greed daily interview. Remember, you should get professional advice before making any investment decision. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.